You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball, my co-host John McEwen. In this week's episode, we'll be discussing Next, Boohoo, Inditex, Ocado, Currys, and Peloton. John, should we start with Next?
Yes, so Next had a trading update and it was a very positive one. So Next had a positive trading update with full price sales up 20% in the 8 weeks to Christmas Day, £70 million ahead of management's expectations. And for the fourth quarter, full price sales were boosted by a 45% increase in online sales and a strong performance from the third-party brand Label UK. This was slightly offset by a 5.4% fall in the sales from the physical stores, but full year pre-tax profit guidance has been raised to £822 million, which is 9.8% ahead of 2019. Surplus stock was lower than expected, with stock for the sales down 18% compared with pre-pandemic, and as a result of the strong full price sales. Full price sales are expected to be up 7% on the current year, and pre-tax profits anticipated to rise 4.6%. The group did comment that the warehouse and distribution division had been hit by labour shortages, which had affected their delivery service. Interest income for the finance division fell by 2.5%, but going forward, the group are expecting to generate at least £345 million of free cash flow for the current year. The group do caution on a number of uncertainties, however, and that includes the reversal of the pent-up demand as a result of the COVID-19 becoming more tempered and reduced discretionary spending as a result of increased inflation and increased prices in stores. They said to expect a strong first quarter compared with the lockdown in 2021, but weaker year-on-year growth in the final 3 quarters. Further special dividend of £1.60 has been announced, and the group is planning on returning to the pre-pandemic ordinary dividend cycle in the year ahead. Shares were broadly flat on the announcement, and if we look at valuation for Next, it has a market cap of just under £10.2 billion and trades at 14.4 times forward earnings. That's slightly down on its historical average. And in terms of my thoughts on this trading update, I thought it was very positive with impressive numbers, particularly from the online division, which is higher margin, and that's more than offsetting the decline in the physical retail. I suppose the ongoing concerns about how much rising inflation and the potential reduction in discretionary spending is going to hit Next. But I think it's probably reflected in the valuation, and it's not particularly expensive for what is a very high quality retailer at 14.4 times forward earnings, which is slightly below the 10-year average and has a prospective dividend yield of around 2.7%. So it's a company that I like. I don't own shares in it, but I think it would definitely be one for my watch list. Sam, what are your thoughts on this trading update from Next?
It's already a high proportion of sales that come from online, isn't it? So in 2021, of the total sales of 3.6 billion, 2.3 billion were online. However, that's because retail was absolutely hammered. The year before that, it was total sales of 4.3 billion and 2.1 billion were online. So it was about 50-50 pre-pandemic, and then it's obviously massively shifted because retail got hammered. But if that's still going up 45% year over year off such a high base, because so many of the retailers we see, although the online numbers are impressive, it's usually off a very low base. This is impressive, but it's off a high base. I think it's really, really impressive. I know you mentioned inflation concerns, but I don't understand why it doesn't trade at a higher multiple.
Yeah, and it always seems to beat expectation, or at least hits expectations. I think it's an impressive business.
It's not just the quality, it's the track record as well. Because every time we cover them, it's just been positive. I think 14 is very, very cheap, especially if you were to look at some of the other retailers you can get for sort of 14 times earnings. You can get some good retailers for 14 times earnings, but a lot of them don't have the track record of growth that Next has.
I don't think they have the consumer loyalty either, which seems to generate.
And the dividend yield's pretty decent as well.
It's very decent, very decent. Would you be buying shares or watch list at least?
I think it's probably, for me, it's probably the opportunity cost would be the reason I didn't. But it is a very, very good business, and I can understand why someone would. I think John Kingham's got shares in it.
Interesting. Yeah.
But it is. I can see the appeal of it. I think it's a really, really good business.
Okay, so on to opportunity cost. Next company we've got is Boohoo. Is that a retailer that you would be buying shares in as opposed to Next?
It possibly is, actually.
Okay, go for it.
So Boohoo, this is last month, they came out with a trading statement and they lowered their guidance for the full year. So they said that in the 3 months to 30 November, sales, including the impact of discounts and returns, rose 10% from the same period in the prior year to 506.2 million. And strong sales growth in the UK outweighed declines across other regions. Rising shipping costs throughout the period meant gross margins fell 1%, and the group lowered guidance for full year sales growth to between 12 and 14%, and that's down from 20 to 25%. Freight cost inflation is expected to shave £20 million off cash profits at the full year, with margins between 6 and 7%, at least 2% lower than initially forecast. And this is about a month ago, this trading update came out, but the shares fell 13.9% on the day of the announcement. In a bit more detail, the UK was the group's strongest segment, with sales up 32% compared to the prior year at 320.3 million. Return rates were 12.5 percentage points beyond last year as customers bought and returned an exceptionally high number of dresses. I wonder if it's all them Christmas parties that got cancelled. Sales in the US fell 14% to 104.6 million as reduced air freight capacity caused significantly longer customer delivery times. In the rest of Europe and rest of the world regions, sales declined 12% and 21%. The group saw revenue in Europe start to recover in September, but it declined throughout the remainder of the period due to customer uncertainty. The group currently has net cash of 70 million and access to over 170 million in cash and credit. The first US distribution centre is expected to come online in 2023, but management is considering options to pull this forward. In terms of the valuation, there's no dividend, but the company's trading at a PE ratio of 13.4, and that compares to an average PE ratio since listing of 40.2. We've covered Boohoo and ASOS fairly recently. We like both of them. My view is Boohoo's a slightly better business. It's got a few problems with the shipping and the higher returns, but this is a business that's still growing. It's got an excellent track record. I just think at a P of 13.4 and it's still growing, 12 to 14% a year. And I think that figure is going to go back up. I think it's going to start. Maybe it won't go back to the 50% growth rates we've gotten used to, but I think it's going to go back to 20% plus. At a P ratio that cheap, I like it a lot. I think it's unbelievably cheap for the growth that it's putting up. And I think the problems it's got, they're not great, but they are temporary problems. I think in 2 or 3 years' time, I don't think these problems are going to still be affecting the business. What do you think, John?
I would completely agree with you. And I suppose it's the fact that it's had to revise these things down and the market hasn't liked it. But when you look at other companies of lower quality that are trading at that price, I mean, Boohoo really stands out as something that's good value.
If we go and look at the share price, the market cap's 1.4 billion now. It's currently at £1.10 a share, and that compares to a 52-week low of 96p and a 52-week high of £3.78. And I mean, if you go back to, since about 2019, the shares for most of that period have been over £3 a share. So it's just been absolutely hammered. So it's down 68% in a year. But it's just really, really cheap, considering this isn't a shrinking company. It's still growing.
Yeah.
And it's still got a lot of growth ahead of it, especially, with like the distribution center in America and stuff. I think there's a lot of promise there. And if you compare it, I think it was something 20s Trader talked about when he came on the show. If you compare it to its American peers, it is really, it's really cheap by any metric, but Yeah, I'm actually thinking about, I'd have to sell. The only thing is I'd have to sell something to do it. But I'm thinking of opening a position in probably like the next few days, actually, because there's 2 or 3 times now we've looked at it and we said it's really cheap. We should think about buying it, and then we've stuck it in the fantasy portfolio. And I'm looking at it again and thinking, why haven't I done anything? Because it's not going to. I don't think it's going to stay like this. In a year or two, I don't think it's still at £1 a share.
No, I would tend to agree with you. I may well mirror that. So you would choose next. You choose Boohoo over Next.
Oh, we'll get to that at the end. No spoilers. But I am seriously thinking about opening a position in Boohoo in the next few days.
Fair enough.
I'd possibly have to sell. What would I sell? Probably Ibstock. That's already
okay. I
was thinking about getting rid of that anyway.
Fine. How's your Ibstock performed out of it?
It's done fine. I bought it. It was like sort of near the low, so I'm up.
When were the lows for Ibstock?
It's probably like March 2020 or something like that. So it was when everything was down. It wasn't like particularly brilliant move on my part. I could have bought most FTSE stocks and probably got similar. I think it's up about 25%. So it's a decent return, but I do like Ibstock. I think I said last time I covered it on the show, I just don't really see where the growth comes from. I think it's a good steady company, but I think I'll probably get better returns out of Boohoo.
Fine. So continuing the theme, on to another fashion retailer, Inditex, which is the owner of Zara, had their third quarter results out last month, with third quarter sales up 21% over 2020 levels and 10% over 2019 or pre-pandemic levels. And autumn and winter collections had been particularly well received. Full year gross margins expected to come in at around 57.5%, which exceeds both 2020 and 2019. In the 9 months from February, sales were up 39% to 19.3 billion euros, helped by online sales doubling compared with 2019 and up 28% on 2020 levels. Operating income was nearly 3 times higher at 3.3 billion euros, reflecting both operating leverage and revenue increase. Migration to the new digital platform is now 97% complete, according to the group, integrating online and physical store inventories, avoiding excess stock being tied up and being able to react more quickly to the latest fashion trends. Inventory itself was up 19% on 2020 levels and 6% on 2019. Net cash came in at 9.6 billion euros at the end of the third quarter, which was up from 8.3 billion euros last year. And the group had rationalized the estate with 6,657 stores compared with 7,197 stores at the same point last year. And shares were down 2.7% on the news. In terms of valuation, Inditex has a market cap of 86.2 billion euros and trades at 22.7 times earnings, which is actually below its 10-year average of 25, and it's set to yield in the region of 3.7%. I think definitely good results. Similarly to Next, but I mean, we've talked about Inditex in comparison with Next before. It trades at a significant premium. I think the other thing to probably comment on with these results is that it does have a slightly higher price point than Next, but it's not the luxury products that companies, or it doesn't have the luxury status of products from companies like Burberry. So you wonder whether, in the current environment, it would feel more pressure than either the companies right at the bottom, the discounters, or those sort of companies right at the other end, the luxury retailers. And it's more expensive, or its shares are more expensive than some of the competitors. So I probably wouldn't be buying shares in it, but it's not to say that this isn't a strong performance and it won't continue to perform well. I certainly wouldn't bet against it, but probably not for one for me at the moment. Sam, thoughts?
Similar to you, really. I think 10% above 2019 levels is impressive. Good results, good business. You've just got to pay up for it. And I think when you look at the alternatives you've got available, I just don't know why you'd want to pay 22 times earnings. I mean, the dividend yield's pretty good at 3.7%. I wonder if it's a bit of a bond proxy, and that's partly why. It is a quality business, but I'd rather have Boohoo at 13 or Next at 14. It is quite pricey, and I don't know. Yeah, I mean, 10% above 2019 levels is pretty good, but 10% growth over 2 years. If you're paying almost 23 times earnings for it, I don't think that growth is really enough.
Yeah.
But very good business.
On to the next company then, Ocado.
Yeah. So Ocado, favorite of the show, the online supermarket. So Ocado have come out with a trading statement, and for Ocado Retail, which is the joint venture they have with M&S, they've said that 2021 is expected to be in line with guidance. A strong demand is offset by labour shortage and capacity constraints. Shopping habits are returning to pre-COVID levels. Retail revenue in the fourth quarter of 547.8 million was up 31.6% on 2019, but down 3.9% on 2020. And that reflects an 8.5% increase in average orders per week to 375,100, but a 12% fall in the average basket size as people spend less time at home. Trends in the fourth quarter have been positive, and the group was predicting its best ever Christmas. New capacity came online at Andover and Purfleet in the period, and Erith performed in line with expectations. New customer fulfillment centres are expected to open at Bicester and Luton in the next 2 years. About 50 million will be spent across new capacity and increased marketing next year. The shares were up 4.2% following the announcement. And this is on the back of the half-year results, which we did cover when they came out back in July. But just as a summary for the half year, the revenue rose 21.4% to 1.3 billion. And on the retail side, which is a joint venture with M&S, revenue rose 19.8% to 1.2 billion. In terms of the valuation, there's no earnings, there's no dividend. However, it does trade at a price to sales ratio of 4, and that compares to a 10-year average of 2.7. I think it's worth touching on the share price as well, because last time we covered it, I think it was over £20 a share, I think, and it had a market cap of around 20 billion. It was around or slightly higher than Tesco, which we thought was outrageous. That's come down a little bit now. It's now at about £15 a share with a market cap of 11.6 billion. In terms of the share price performance, it's down 34% in a year, up 17% over 2 years, up 86% over 3 years, and up 503% over 5 years. My view is this trading statement's fine. I think Ocado's a good business. I think the products look fantastic. If you've ever been on YouTube and watched the warehouses in action, it is really, really impressive. But I think for the valuation this thing has, I think every single number needs to be heading in the right direction. And that's not the case here. I think average basket size falling, that's concerning. Retail revenue down on the previous year. I appreciate that, it's got up against tough comps, but we've seen Tesco have come out and they've beat the 2020 figures. So it is possible to do it. It's not just an excuse. I think the higher quality businesses have beat the tough comparatives and Ocado hasn't. And I think for the valuation that you're paying, there's meant to be a lot of growth ahead of it. And if it's not delivering, I just, especially with such a capital intensive business as well, I don't see where the returns come from if you're buying at like this valuation. What about you, John?
Yeah, I know, complete agreement. I don't have much more to add than that, and I wouldn't even be looking at it.
No, yeah. I mean, at least it's not worth more than Tesco now.
It's not more than Tesco's, no.
So at least it's got that in its favour now. But yeah, I think it's a really impressive product, but it's like, well, the fact that we're even using a price to sales for something that is low margin and very capital intensive, and you don't even know how long the products are going to last. So it's very, very difficult. So like they talk about like so for the customer fulfillment centers, you don't actually know how long they're going to take to pay off because you don't know what's going to happen with them in the future. So there's just so much uncertainty that, I don't know, for me, it would have to be a lot cheaper for it to justify even looking at it. And I mean a lot. I mean, if it fell, I mean, it's down. We've been covering this since we started the show. So like it's down, it's down almost 50% from its peak. And it's been cut in half, and we're still looking at it and saying it's still really expensive. And I think it could get cut in half again. And I'd be saying exactly the same thing. It is just so expensive.
Yeah. I agree. Okay. On to another retailer, more traditional retailer, Currys, which traditionally electronics. They had their half-year results out last month. Revenue was broadly flat year on year at £4.8 billion, and growth in the international business has been offset by a drop in the UK and Irish markets. Underlying operating profit remains static at £91 million, despite cost reductions and higher store sales, helping profits in the UK and Ireland. Management also cautioned that global supply chain issues were likely to persist and market demand soften, meaning that the immediate outlook has become more uncertain. Full year adjusted profit before tax is still expected to be around £160 million, though. If we break the results down a little further, the UK and Ireland revenue fell by 4% to £2.5 billion, with a 3% drop in like-for-like sales. Store sales were up 28% with the reopening of physical retail, and online sales fell 12%. They currently account for 43% of overall sales, which is significantly above 2019 levels. A move to higher margin store sales helped underlying profits, which came in at £23 million compared with £10 million last year. In the Nordic region, revenue was up 3%, but like-for-like sales were down 1%. Online sales rose 9% and account for 24% of overall sales. Increased costs and lower margins from the online sales meant that operating profits fell £17 million to £57 million. In the Greek division, revenue grew 15% to £280 million, with like-for-like sales up 8%, and the 2 new stores in Cyprus performed strongly. Online sales grew 11% to account for 8% of total sales. Underlying operating profit increased from £7 million to £11 million, aided by the sale of insurance products. Free cash flow came in at £185 million, down from the £499 million last year, due to an expected decline in working capital inflow over the half. Net cash stood at £250 million compared with £269 million last year. An interim dividend of 1p per share, along with a £75 million share buyback, is due to begin this month. Shares were down 7% on the news. The valuation of Currys, it currently has a market cap of £1.4 billion and trades at 9 times earnings, compared with a 10-year average of 11. Currently yields about 3.6%, and they've announced this interim dividend. In terms of thoughts on Currys, it's not one I like. I think it's particularly vulnerable to big retailers, big online retailers like Amazon. I think the numbers, given that we've been coming out of the pandemic, or certainly we have been over the period that these results cover, I think they're very disappointing, and you've got a lot of people with arguably a lot of disposable income before the inflation has been really creeping in, and it hasn't been reflected in these numbers. I think it's also worrying that despite sales in stores going up, that the online sales have been coming down too. I don't think it bodes well for the longer term. I suppose you've seen consolidation in the electronics physical retail, but I mean that's in response to the tough competition that's out there in the online space. Yeah, I definitely wouldn't be buying shares at any price in Currys. Sam, thoughts?
Similar to you, but I guess I'm a bit less skeptical. I think, and I am just thinking out loud here, I think the revenue is poor compared to last year, particularly in the UK. Do you think everyone being locked inside last year meant they possibly spent more on like white goods and TVs than they otherwise would have? Because if you're just locked inside with nothing to do, it's probably a good time to get a bigger TV. So I do wonder if there's maybe quite a bit of demand was pulled forward because of that. I
suppose I guess in terms of TV purchase, you'd have had the Euros as well. That is true.
Although the Euros would have fallen into this half.
That would have been,
So maybe it should be better because they're not going to get the Euros again next year.
Yeah.
Although we do have a World Cup coming up.
Yes,
So.
that's right.
But I don't know. The online sales is disappointing, but it does make up quite a high proportion. 43% of overall sales in the UK are online, which is that's decent for a retailer. I mean, I'm also surprised that the Nordics business is so high. I had no idea, but the Nordics revenue is 80% of the UK revenue. I just had no idea that, and that's only online sales only make up 24% of overall sales there. So they can do a lot more with the online there. It's a tough one. No, the dividend yield's pretty good. I think in the UK it's probably pretty saturated, and like you say, it's so competitive. I mean, it's not just Amazon, but you've got like AO, which we've covered before on the show. You could just go through. I could list 10 different places where you can get exactly the same products. I think the valuation's actually quite reasonable for the business you're getting, but similar to you, there's just no price I would ever buy it. I think consumer electronics is just an industry I would never ever touch because there's no moat. There's just no competitive advantage unless you're the lowest cost retailer, and that's always going to be Amazon. If you're up against Amazon in something like that, I think you're always going to be up against it, and that's probably why the shares are at such a reasonable valuation. Because in 10 years' time, it might not be here. I think it is that tough an industry that it could be perfectly healthy now, and in 10 years it could just be gone.
Yeah, and you look at lots of those high street retailers that were there in the electronic space that no longer are.
What is that? If you go down the high street 20 years ago, completely different set of shops. And in 20 years' time, it'll probably be the same. Because AO, AO weren't really a thing 20 years ago. I appreciate a lot more of that's online and stuff, but it's just it's so competitive. It's like fruit flies, isn't it?
Yeah. So US company of the week and one you like, Sam.
Yeah, one you don't like as much. One that you didn't want in the fancy portfolio. So Peloton. Well, it's not great. Part of the reason you didn't want it in the fancy portfolio, in your defense. So they've come out with their Q1 results. I say come out with, they actually came out with them back in December. But, well, the companies that have come out with results in the last few weeks, I've not seen any that are particularly interesting. So I thought we'd go back and cover Peloton, especially since I own it. So I needed to have a look at some point. So they come out with their Q1 results and for the 2022 financial year, and for the quarter, connected fitness subscriptions grew 87% year over year to 2.49 million, and paid digital subscriptions grew 74% to 887,000. Total members grew to over 6.2 million. Q1 total revenue grew 6% to 805 million, and these figures are all in dollars. Q1 connected fitness subscriber workouts grew 55% to 120.5 million, averaging 16.6 monthly workouts per subscriber versus a 20.7 average a year ago. Q1 average net monthly connected fitness churn was 0.82% per month, with a 12-month retention rate of 92%. Q1 gross margin was 32.6%. Connected fitness product gross margin was 12%, subscription growth margin was 66.7%, and subscription contribution margin was 69.6%. Q1 net loss was 376 million, or $1.25 per diluted share. The Q1 adjusted EBITDA was a 233 million loss, representing an adjusted EBITDA margin of negative 29%. They've said that given the unprecedented circumstances presented by the pandemic, it is more challenging to guide for their expected results, and they're therefore returning to presenting ranges for the guidance. So for the 2022 financial year, which we've just had the first quarter of, they're guiding for 3.35 million to 3.45 million connected fitness subscribers, and that's compared to 2.49 million presently. And they're guiding for 4.4 billion to 4.8 billion of total revenue. And that compares to revenue in the prior year of just over 4 billion. They're guiding for gross profit margin of 32% and a $425 to $475 million adjusted EBITDA loss. Don't know who said this. I'm assuming it's the CEO, but it doesn't actually say. It's just a letter to shareholders in the earnings. But highlights from the letter say, during the first quarter, we took 2 significant steps in support of this broader strategy. First, on August 26, we lowered the price of our original bike to $1,495 or $39 a month with 39-month 0% APR financing. We continue to believe price remains a barrier to purchase for many consumers, and this is our latest step to improve the accessibility of our platform. We're pleased with the consumer response to our new price, which quickly converted many consumers already in our purchase funnel and is helping to generate a significant number of new leads. We launched our all-new tread in the US on August 30, relaunched in Canada and the UK on the same day, and expanded distribution to Germany on September 28. The tread features an industry-first combination of both physical and digital safety keys, provides an exceptional running experience, and is a portal to a full body strength and cardio workout. Initial member feedback has been very positive, and compared with Bike and Bike Plus, our tread has lower product awareness and a longer purchase consideration path, including many wanting to visit showrooms to see, touch, and experience the product. For the revenue, it's worth mentioning that the total revenue of $805 million for the quarter was up 6% year over year, but up 250% versus 2 years ago. For subscriptions, which I think is the most valuable part of the business, I can get into it a bit more later, but I have no issue with them lowering the price on the bike. I think you sell as many bikes as possible. You don't need the Apple-like margins on the bikes because the money in this business is going to be made on the people that buy the bikes and then have to pay $40 a month to use the bike if they want to. And I think the more bikes you sell, the more subscriptions you get, and that's where they'll make the money in the future, I think. But yeah, subscription gross profit was $202.7 million in Q1, representing 121% year-over-year growth. The margin was 66.7%, and that was up from 58.5% a year ago. The contribution from subscriptions was $211.7 million, and that represents 111% year-over-year growth. And the subscription contribution margin was 69.6% versus 64.1% a year ago. And they've said that improvement reflected continued fixed cost leverage as well as modest efficiencies associated with certain variable costs. In terms of the operating expenses, total operating expenses were $622 million, and that grew 140% year over year, representing 77.3% of total revenue versus the prior year period of 34.3%. Sales and marketing was $284 million, and that grew 148% year over year. Part of the reason was they were able to just shut down the sales and marketing because they had so much demand in COVID. They didn't really need to advertise, and they couldn't make enough bikes quick enough anyway. So it's not particularly concerning. You would expect that to go back up. And sales and marketing represents 35.3% of total revenue versus 15.1% in the period a year ago. And they've said that was primarily driven by advertising and marketing spending in support of the original bike price reduction and the launch of the lower price tread. General and administrative expenses were $240 million and grew 121% year over year, representing 29.8% of total revenue versus 14.3% in the prior year. Year over year growth was driven by increased professional service fees, continued investment in their systems and teams, and acquisition integration costs. R&D was $97.7 million, and that grew 167% year over year, and that represents 12.1% of total revenue versus 4.8% a year ago. Growth was driven primarily by increased personnel-related expenses and research costs associated with the development of new software features and products. It's also worth pointing out on the actual earnings call, I think I've already discussed this before on the show, but on the call, the CEO was asked about whether or not they'd need to raise equity because the cash position is getting a little bit low now. The CEO was adamant they would not be doing an equity raise within the next few quarters, and about 2 weeks later they did an equity raise, and they did the equity raise at a much lower price than they could have done if they'd done it at basically any other point in the past 12 months. So that's not particularly great. In terms of the valuation, the price to sales is now about 2.75x, so under 3, and that compares to, at the high it was something like 11 or 12 times sales. And if you were to take a price to gross profit, it's 8 times gross profit. The share price performance has been absolutely horrendous. So the share price is $34 a share, and that compares to a 52-week high of $171 a share. So it's down 77.66% over the past year. To put it into context, it fell from about $171 to, I don't know, like $90 or $100. And I thought it had come down quite a lot. It was down like 40 or 50%. And my view was basically, how much cheaper can it get? Well, I'm down about 60%. So the answer was a lot. So yeah, Jordan, thoughts on these results and the valuation?
Yeah, I mean, I'd be equally upset about the equity raise and the time that it was done, especially after the, 2 weeks earlier, the call from the chief executive. But no, I think I really just want to see a lot more fundamentals for the business and earnings really before I look to buy shares. And I appreciate, in terms of price to sales, it may be cheaper than it has been historically, but it's
lower than Ocado.
It's lower
price to sales than Ocado.
I don't like Ocado either. So yeah, I can see the things that you do like about it as a company, but I think it probably has a very long way to go before that sort of the vision is achieved, really. So it isn't something that I'd look, any further than just on the surface of it, really.
Don't think you'll be going into the fancy portfolio next year then either.
I mean, things could change a lot, and maybe I'll have changed my view, but not at the moment. I couldn't see it.
Right. So of the 6 companies we've covered then, next, Boohoo, Inditex, Ocado, Currys and Peloton. If you had to buy one, which one would it be?
I'd go with Boohoo.
I'd go with Boohoo as well.
The reason, I mean, as we outlined before, I think it is a good quality company. I know things haven't been as easy for it, and numbers have been, or forecasts have been revised down, but I think it's very good value at the moment. It does have earnings.
Yeah, without being boring, I agree. I think Peloton would probably be second for me, and I reckon next is your second choice.
Yeah, you're right.
So at least there's some
but your fundamental thesis behind Boohoo, you'd be comfortable with holding it. Would you add any more to it?
Well, I don't own Boohoo. I own.
No, sorry. Peloton.
I might open a position in Boohoo in the next few days.
Yeah. Sorry.
I did seriously think about adding to Peloton actually on the back of those earnings. The only thing that stopped me is the CEO on the earnings call.
Yeah,
I think for me there's plenty of other businesses I can add to. It's in the sin bin for that basically. Otherwise, I probably would be adding, because I think, although it's not the best set of results in the world, I think hidden within those results, the digital subscriptions were very, very good. And for me, that's what
that's the key.
My whole thesis is based on anyway. So as long as those figures are moving in the right direction, but I don't really like it when management lie.
Yeah,
it's not something you look for.
No, fair enough. But you hold your current position.
I'll be holding it. Yeah.
Fine. Okay. Well, thank you for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.